Okay, everybody, we're going to get started here. You've joined us for Untangling the Mortgage Maze, Home Loans Made Easy. We're going to have some fun. We got Laura Duggan and Todd Curio joining us this evening. And just a little bit about, I guess, myself first. I'm Patrick Birdsong. I've been working with Laura Duggan for about 8 years now. Yep. And we just have a lot of fun listing and selling real estate. Laura is the broker-owner of West Austin Properties. She's a second-generation realtor. It's a family-owned company through and through. And she's also third-generation native Austinite. 31 years in the business. If she doesn't know what's going on in real estate, nobody does. Todd Curio is the best lender in Austin, Texas. He is always ahead of the curve on knowing his stuff. BBA in finance from UT, Hook 'em Horns, as we all are UT grads, and his MBA from Texas Tech. He's also co-owner of Capstar Lending, and just one of the best one of our most valuable resources for our team. We call him anytime we have any issues with loans. So we're going to cover a lot of things tonight. First of them is the 3 best loan types and how to qualify for them. Credit scores and interest rates, seller-funded closing costs and prepaids. It's always good to have sellers pay for some things. How to avoid mortgage insurance. That's a big one. It can make your loan a lot more expensive. New appraisal rules and choosing a lender. And yes, it really does matter. Rundown, we're going to do about 45 minutes of information. Then we're going to jump into a Q&A for the last 15 minutes. So as we're going through this, feel free to jot your questions into the thing, and we're going to go through them at the end. So keep them coming. So we're going to get started. Laura, you want to tell us a little bit about pre-approval?
Thanks, Patrick. I am so glad to welcome Todd Curio. I met Todd, I guess it was probably in about 1992, and he came into my office one day and introduced himself to me and sat down with me and showed me some really amazing stuff. I had never really known the back end of the business like he taught it to me. And I was able to recognize all kinds of things, and I learned quickly that unfortunately not all lenders are honest, and I really, really respect Todd for his integrity and his knowledge, and he has been my very most valuable asset in my career in doing the sales that we've done, because I never have to worry about a buyer when I send him to Todd. And you know, if Todd can't do the kind of loan that they want done, or there's some other resource that buyer could use, Todd's always the first one to point that out, and I always appreciate that. So the very first step in purchasing a home, before you do anything, you need to get pre-approved for your financing. And there are a lot of reasons for that. One, you want to know how much home you can afford, and that's one number. The other number that a buyer talks with the lender about is how much they really want to spend in their buying power. So not only will you find out what your limits are, both imposed by the lender, but with your own limits as well. Because knowing this information is going to give you a lot more buying power. It's going to leverage you in the negotiation. With the return of spring just around the corner here, our market is heating up, and there are some areas and neighborhoods right now that are drawing multiple offers. So if you do not have your financing in place, and we can't take a letter of pre-approval with us when we submit your offer, that's just such a powerful thing to be able to present that letter to. If there are multiple offers and you don't have your financing in place, someone is likely to get that property that has their financing in place, or it's not incumbent upon.
Laura, I wanted to speak to that real quick. I saw over this past weekend 2 different situations where there's multiple offers, and it's mainly due to new inventory coming on the market, and majority of the old inventory, the homes that have been sitting on the market for 6 to 8 months, people have seen them. They're not interested anymore. They want to see new properties. And so I think there's a lot of pent-up demand for these buyers.
Yeah, I agree with that too. I had a transaction not very long ago where there were 3 offers on the property. My offer with my buyer was actually the lowest one out of the 3, but my buyer had already done their homework, had been to the lender, had gotten pre-approved for the financing, and so we didn't make their offer contingent upon financing at all. That was very, very appealing to a seller that wanted to sell and get out quickly. So, and it's going to reduce your time from contract to close. It's taking longer now, isn't it, Todd? How long is it taking now to get through, get a loan through, basically?
Well, the normal time used to be you could easily get one done in 30 days, but now it's getting stretched out to 45 days. Just a lot more is involved than used to be. If you thought paperwork was there before, it's paperwork times 2 or 3.
Yeah.
We're still getting people loans, well-qualified people. It's just a little more cumbersome, if you will, but it can be done.
Well, and with when someone comes to you early and they submit all the paperwork that they need to get their loan done, and you've got that process, then it's a great time to go out and find a house. When you find one, it really does reduce the contract to close.
Yeah, Todd, can you tell us, it's been a while since I've sat down and qualified for a loan myself. What's that conversation like when you first talk to somebody to buy a property?
Well, the first thing we're going to do is we're going to look at the employment and history. And a lot of people have misinformation that you really have to be at a job for 2 years. We really look at stable monthly income. So you could have gone from one employer to the next. As long as you didn't have a big gap in employment from one job to the next, they're really looking for that stable monthly income. And so if you have gaps longer than 30 to 60 days, you just need to explain, hey, I was out looking for a job, or we moved from one place to the next. And that's perfectly fine. Now, if you're self-employed, meaning you started a new business, and you haven't had a 2-year history of being self-employed, then that gets to be the issue, because we need a 2-year history of being self-employed with tax returns. So if you've been self-employed in 2010, but you haven't filed the 2010 tax return, then the lender looks at it like you really haven't even worked in 2010. So it really needs to be 2 years of tax returns with that documented income. And so that's really the key. A lot of people have been in school and weren't in the workforce. That's perfectly fine. We just need to document a 2-year history. So if you were in school, we'll get a transcript or a fee bill or something showing you were in school, and that would take the place of a W-2 or a pay stub for that time period. So that's not a problem at all.
That's interesting, definitely.
So what about some of the other things like acceptable credit?
Well, the credit is a key thing, because that's something that people haven't pulled their credit report. They really haven't looked at it in a while, and we seem to be kind of the guy that catches that credit, if you will. There's a lot of mistakes in the credit bureaus these days, and so I would encourage you, we go ahead and pull 3 bureaus when we do a pre-approval, and a lot of people go online to get their free credit report. You can go to myfico.com. That's myfico.com. They'll give you a copy of their report, but that's only one bureau. So if that one bureau has your credit perfect, then that's okay. But there's 2 other bureaus that could be reporting information that Fair Isaac or MyFICO is not reporting.
Now, one of the things I've heard is that if you pull your credit too many times, that's a red flag too. Tell me about that.
Well, credit inquiries, meaning if you're shopping around for credit, is one indicator or scoring model that they use. Inquiries would be if you're shopping around for a car loan, if you've gone to Foley's and they've offered you 10% off. Try to not do those, because really that's just multiple inquiries. Gives the credit bureaus a hunt that hey, I'm out there hungry for credit. I need credit. And so that can penalize you. Now, if you're shopping around for a mortgage, if we pull it, our inquiry is it's coded as mortgage related. And so if you do that in a 30-day period, if we do it and 2 other lenders do it, then that would all count as one inquiry if it's all done within the 30-day period. So I'd encourage you to shop around for a mortgage. You want to be an informed buyer, and as long as you do it within the 30-day period, then you should be okay. Where the problem exists, if you were shopping around for a mortgage and then you went to Foley's and got a new card, you went shopping for a car, all those things would be a detriment.
And we would say shop for your home first, get in there, close it, and then shop for anything else that you need to have. Because you don't want to have new car payments and all that kind of stuff stacking up against you.
When the credit gets run at the beginning, does it get run a second time after you go under contract?
Generally, the credit report is good for 4 months or 120 days. Okay. The only thing we do at the very end is more of a quality control purpose, is we do what's called a refresh. It's considered a soft inquiry, wouldn't affect your score negatively. And basically the purpose of that is to make sure that you haven't established any new debt since you were first approved for the loan. So if you snuck out there and got a new Home Depot card, those things, it won't penalize you, but we just need to know if it's something that's significant. If you went to Home Depot and got a little, $50 deal, that's no big deal. But yeah, if you got the Ferrari and you had a $2,000 car payment, then that would be substantial. So stay away from that.
What about, I've even heard now that they're checking your employment the day before closing or right before closing.
Yeah, these lenders, they still want to make sure you're employed before we loan you a lot of money. So you definitely want to stay employed all the way through closing. With most lenders, including us, normal procedure is verbally verifying the employment within 48 hours. A lot of lenders will do it the same day. So don't quit your job in the process. Try to at least stay through the funding of the loan.
Well, and it takes a lot of patience these days to get through the process, and I'm sure you've read in the paper there are all the horror stories. But if you have a good, competent lender, and you have there are several factors to getting things through smoothly, and one is local underwriting and local loan processing. I know Patrick and I have both had frustrating experiences with people who wanted to use an internet lender, and then here you come up to closing and nothing's done. You can't put your hands on the people, etc. Well, let's get right into the two types of loans, because I want Todd to talk to you about both of them, both the conforming loan and the non-conforming loan. And I think we should go talk about the conforming loan first.
Yeah, there's mainly two types of conforming loans. Really, the FHA technically wouldn't be a conforming loan, but generally loans that are under 417 are conforming loans. Let's go ahead and start with the FHA loan. That's probably the most popular first-time homebuyer loan. It's a minimum down payment of 3.5% down. FHA sets the loan limits for different areas. So for the 3-county area around Austin, it's $288,750. So really, you could have a purchase price up to $299 with just the minimum 3.5% down. Now you can buy a house over $299, but you would just have to come up with more than the 3.5% minimum down payment. The credit score minimum is 640. That's another reason we really recommend you coming in early to get pre-approved, because we have a lot of cases where people, when they come to us up front, they don't have the 640 credit score. We have resources with a local credit reporting agency where they have ways to help get your credit score improved. And so a lot of people don't have the 640 because for whatever reason there's mistakes, medical collections they thought were supposed to be paid by the insurance company, bills that they thought were paid, when they moved out an apartment complex, just various things like that people had no idea that were out there. And so if you come in early, we can help get those things fixed and get that score up to at least the 640 minimum.
And that's not really that hard either, because sometimes it's a matter of contacting the bureau and submitting a letter, right, or showing proof that those things were paid. So that's another reason to get in early.
Yep. Also, FHA has higher debt-to-income ratio, and so a conventional loan would generally have debt-to-income ratio, meaning your total monthly debt, which would be calculated with things that generally show up on the credit report: minimum payments on car loans, minimum payments on credit cards, minimum payments on student loans. Those items would be considered in your debt-to-income ratio. That, along with your total mortgage payment, what they call PITI, principal, interest, taxes, and insurance. That would all be considered your debt to income ratio. Conventional, they generally like to keep it at 45 to 50%. FHA will go all the way up to 55%. They're a little more lenient on student loans that are deferred. There's some nuances between the two, and so you definitely want to consult with a lender to find the one that works best for you. FHA, all the down payment funds can be a gift. A relative can give you a gift. I think the IRS says that you can get a gift from somebody up to $13,000 without paying income tax. So your mom could give you $13,000. Your dad could give you $13,000. If you're married, they could give.
So that would be $26,000.
Easy, yeah.
Yeah, together, mom and dad.
And who can gift to you?
Generally, it's defined by a family member or somebody that has a long-standing relationship with you. So they just don't want you to find a bum on the street that says, hey, I can give you a gift for down payment, because then it looks like it really was a loan, not a gift.
Gotcha.
Generally, non-secured loans are not eligible. You can get a 401k loan because, in effect, you're borrowing your own money. So that's a real popular source for down payment.
That's interesting.
And just quickly back, another one of the benefits is that the FHA loan is assumable but qualifying, correct? Still?
Correct. And a lot of people hear the word assumable, and back in the late 80s, they had what they called non-qualifying assumable loans, which means that you didn't have to qualify for the loan. And so people would qualify the loan that didn't meet with a lender. They just took over the payments, and those loans kept coming back to the original borrower. Assumable loan with qualifying means a new person that buys your house has to qualify for the loan, and that gets you released of your liability.
If you ask for it to be released, there's a form for that.
And the most important thing is that is because if rates are 4 3/4 to 5%, and you go to sell your house in 5 years, and Laura says, hey, don't you remember you did an FHA assumable loan, and rates are, say, 7% when you go to sell, then you have a much more attractive thing when you go to sell your house when your neighbor is trying to sell his house, and the person that's buying his house has to get a new loan at 7%, whereas the person that's buying your house can assume your 4 3/4% loan. So it's an attractive feature when you go to sell it.
Since I've been selling real estate, in 1979 I started, and Brad and I bought our first house and the rate was 17.5%. So think how amazing a 5% interest rate is now. It's just still such an amazing time. But as we all know, rates are cyclical. The government is really keeping them down artificially right now. So when those rates start to go back up, all of the FHA loans that are assumable will be very attractive, even though the buyer will have to go through the same process, submitting their qualifying documentation to the lender that is currently holding the mortgage on that property. So that's something to look forward to in the future.
One of the other features besides the 3.5% down payment is a lot of people hear of the term bond loans or grant programs. And what this is there are programs throughout Texas, and one of them is through the State Affordable Housing Corp. You can just Google State Affordable Housing Corporation. Right now, they're offering a grant program, and we're a participating lender in that program where they'll give you a grant up to 3%. So if the FHA loan requires 3.5% down, you get a grant of 3%. That grant is basically free money. It doesn't have to be repaid. You just have to qualify. And so you can go to stateaffordablehousingcorporation.com and check that out. Also, they have programs called Tax Credit Certificate, and MCC is Mortgage Credit Certificate, and you can do an online search for that. And these are programs where your interest that you paid during the year, a portion of it is a tax credit, which reduces your tax liability dollar for dollar. So the State Affordable Housing Program also offers an MCC, and so really the grant program, it's really free money. And so they do have income limits, so you have to check depending on your family size. The income limits are around $58,000 and above, and so you can go to that website and check out to see if you qualify. But FHA allows to use these grant and MCC programs.
We usually post our webinars at a later date. We record them and post them, and we will put links in the recording so that if you miss them, you can come back and look at these slides later, because I know Todd's giving so much valuable information, but it can be a little bit overwhelming when you're looking at it, quickly. So
one of the other features of an FHA loan is the seller can pay up to 6% towards your closing costs and prepaids. Really, you only need the seller to pay about 3%, and that should take care of all closing costs and prepaids. And so really the goal in most FHA transaction is to get the buyer to just get in for a total move-in of 3.5% down. So on a $100,000 purchase price, your total move-in would be $3,500. The seller could pay for everything. So your total move-in would be $3,500. So you just need to find a family member or a long-standing friend that can give you $3,500 on a $100,000 deal.
I want to also mention that, just even in the paper this morning in the Wall Street Journal, there's a big article, banks push home buyers to put down more cash. So all the things that Todd is sharing with you are as of today's date. And there is a lot of pressure on more down payment, more fees, etc. One thing I want you to address, Todd, what is a prepaid item? If you could just go over some of the buyer costs that would be considered prepaid items.
Yeah, prepaid items are items that are generally recurring things that will continue as your mortgage goes on. One would be homeowners insurance. Homeowners insurance is generally the same thing as hazard insurance and fire insurance. They're used synonymously. But basically, that would be with Allstate, Farmers, or whoever you selected. You would pay a year up front of homeowners insurance, so you'd have insurance on your house. And then you'd have taxes. If you have what's called an escrow account where you put taxes and insurance in your mortgage payment every month, then they build up this escrow account. And so you prepay or you build up a cushion or reserve account for taxes and insurance. And that's what prepaid items are.
So you're just really paying these things in advance. Yeah. Okay. Very good.
The disadvantage of FHA loans is you kind of get double hit, if you will, on the mortgage insurance. It's a government-insured loan, and so what the government does is they build this pool of mortgage insurance. So when people default all across the country, they have this pool of mortgage insurance. And so with the higher number of recent defaults, they're wanting to increase their mortgage insurance, and that's why in April it's going to go up by an additional 0.25% per year. They just reduced the upfront amount. It used to be 2.25%, and that was decreased to 1% upfront, which is rolled into the loan, so you don't have to come up with that in cash. But they did increase the monthly mortgage insurance, so it's 0.9% per year, and that's included in your monthly payment. Now, this mortgage insurance is tax deductible, and when you do reach more than 20% equity, it will be removed.
Will it automatically, or do you have to apply for it to be removed?
It automatically drops. If you make just the minimum scheduled payments, it's generally about 11 years when it'll automatically drop. Now, if you want to pay extra on your mortgage, you can accelerate that. You just have to pay it a minimum of 5 years. So if you continue to pay extra, you could really get rid of it in 5 years.
Interesting.
All right, so conforming loans are for loan amounts that are for 417
and below, and conforming loans would contrast against FHA loan. FHA loan being government insured, conforming loans there is no government insurance, and so these are loans that are under 417. You hear a lot Fannie Mae and Freddie Mac. These loans have to meet these Fannie Mae, Freddie Mac guidelines. And so that's why there's a specific list of requirements that the lender needs on each one of these loans, because these loans are then pooled, if you will, and sold on the secondary market. That keeps the rates low for 30-year fixed because they're pooled and securitized. The down payment's a little bit larger because it's not government insured. You can put down 5% down, and then you have to get what's called PMI, or private mortgage insurance. It's a private mortgage insurance instead of a government mortgage insurance. And so that's really the difference. This mortgage insurance ranges from 0.32 to 0.94%. There's about 4 or 5 private mortgage insurance companies that compete for this business. And so we basically shop around for that just like we would shop your interest rate. And it's based on credit score and the amount of down payment. The larger down payment would reduce the cost of mortgage insurance as opposed to obviously a low credit score with low down payment. And so this is also something that you can get removed when you get to that 20% equity level. And again, it's paid in your monthly payment just like it is on an FHA loan.
And
so
does that automatically drop off too?
It automatically drops off, and you can petition to have it removed sooner. There's a cancellation process, and if you have an outstanding mortgage now, it's really good to look at trying to get that canceled. We'll post this website too, but there's a website called mgic.com, and on their website they have the procedures to do canceling mortgage insurance.
Excellent. So if you're putting 20% down, you don't have to worry about mortgage insurance, but if it's less than 20%, you're going to have the mortgage insurance unless you do blended loans, right?
Right, and that blended loan is considered a piggyback, or what's called a purchase money second.
We'll talk about those in a minute.
We'll be on that in just a sec.
Yeah, let's go back to let's go back to the one more. Yeah. All right, perfect.
Yeah. So really, the difference in conforming loans, the seller can still pay up to 3%, which is basically all you would need on these. You just need a 5% down, and the seller can contribute more if you put 10% down or larger.
Okay, excellent.
Again, why it's really imperative to get that credit score looked at early on. If you go with a conventional loan, the best rate is based on a 740 in credit score and above. And so below 740 to 720 would be about 0.125 higher, and then from 700 to 720 would be another 0.125 higher, and then 680 to 700 would be another 0.125 higher. So you could almost be looking at another 0.5%, not quite, in interest rate if you had a 680 credit score. And that difference between a 680, we had a customer today, they had just one collection, and his credit score was a 682. And he came early on, and we pulled his credit, and he said, hey, no, that's a mistake. We gave him the contact information with the collection company he had never heard of. He disputed it, got a letter from the creditor deleting it, and we repulled his score today, and he had a 766.
Wow, that would have made a huge difference.
And so that difference is really the difference in mortgage insurance. It's a big difference. Interest rate, it's thousands of dollars on a mortgage over the life of the loan. So you really got to get that credit score checked early and get it fixed up.
Well, and how long did it take from you giving him that info to where it changed? Like, what was the process?
The longest part of the process is him finding the creditor and verifying indeed that it was not his. There's a process called a rapid rescore, where if you give us documentation via a letter from the creditor saying it's an error and delete it, we can get your score fixed in 5 to 7 business days.
Wow.
If you do it on your own, just through the dispute process with the 3 bureaus, which are Experian.com, Equifax.com, and Equifax.com.
Yeah. I never can remember.
Anyway, if you do it and just let it happen on its own, it's generally a 60-day process. Oh, wow. And so it's really good, that rapid rescore. It's going to save him a ton of money, and so
time.
So
no kidding.
And we go off the middle score of all 3 bureaus. And so again, you may have one bureau that's reporting misinformation, and so we go off the middle score. So maybe that one bureau, if the other 2 are really good, you won't even have to do the rescore. But that's why we want to check all 3 bureaus
and get it done early. Yeah, for sure.
The debt-to-income ratio, a little more restrictive on conventional as opposed to FHA. 45% debt to income ratio. Generally, you can go up to 50%. And what I mean by compensating factors, a larger down payment would be a compensating factor. A higher credit score would be a compensating factor. A low LTV, those types of things would be a compensating factor that would allow the lender to go a little bit above 45%.
Now, LTV.
LTV stands for loan to value. So if you bought a $100,000 sales price, then an 80% loan to value would mean that you had an $80,000 loan. You had 20% equity. So the loan to value is the loan in relation to the value or the sales price of the house. When you don't have that 80% loan to value, then a great way to avoid this mortgage insurance is to do a second lien or what's called a piggyback mortgage. And what we do is we do one loan for 80% of the purchase price. And with that one loan at no more than an 80% loan to value, that first lien holder does not require PMI or private mortgage insurance. So then we go seek out a second loan or a second lien to bridge the gap from that 80% loan to a loan with 10% or 5%. So the lingo is called an 80-10-10. 80% loan to value on the first, a 10% loan to value on the second with a 10% down payment. And so we facilitate that second loan at the same time. We're currently using a local credit union that has about the rates about 0.75% lower than the statewide second lien lenders. And it's basically a way to avoid mortgage insurance. The second lien rate is higher than the first lien rate, but still much cheaper than going with mortgage insurance. And with that same dollar, you're building up equity as opposed to the mortgage insurance, which does nothing for you. A lot of people think mortgage insurance helps them. If they die, it protects the house. Mortgage insurance does nothing for you. It just protects the lender. So you can't sleep better at night knowing that you have PMI because it doesn't help you. It just helps the lender.
Skin in the game. So let's talk about the interest rate on the second lien, because if you say had a 5% maybe interest rate on the first lien and you borrowed the second 10%, about what would you be looking at for the second?
Well, it depends on what term you use on the second loan, but if you put 5% down, the second loan rate would be 7.25% on a 15-year term or 8% on a 30-year term. If you put 10% down, it's 6.5% on a 15-year loan or 7.25% on a 30-year loan. So it depends. The larger the down payment would reduce your second loan rate because the risk to the second lien lender is lower with a larger down payment.
Okay, awesome. Well, let's talk about jumbo loans, because I know there's still people out there buying some expensive homes.
Jumbo loans are generally loans over $417,000, and they're non-conforming because they're not securitized and sold on the secondary market, just like a Fannie Mae or Freddie Mac loan. And so, since they're not have that implied backing of the government, they carry higher rates. So when a 30-year conforming loan would be close to 5% on a 30-year fixed, a 30-year fixed jumbo would be about 6%. So almost 1% higher for a jumbo loan. They're a little harder to qualify because the down payment requirement would be a minimum of 20%. If you get over about $800,000 to $1 million, you're looking at 25 to 30% down. Now, the example I gave a while ago about a second lien, another way to avoid this jumbo higher rate financing is to put a 417 first loan and then do a second loan. Generally, if you stay below a 750 loan combined, it's better to do two liens than to do one new jumbo loan. So jumbos are just a little bit harder these days.
But for a while they disappeared altogether, so at least the money's loosened up to where you can at least get one.
That is correct. Kind of when the financial crisis started, there's really no jumbo fixed rates out there at all.
Property qualifications. So not only does the buyer have to qualify for the purchase or the loan, but the property has to also meet guidelines for the lender. And one of the most important things is that the property has to appraise for the sales price or more. We're going to talk about some of those new appraisal guidelines in a minute, because they definitely have changed, and it's getting much more difficult. We're not able to select appraisers like we used to. I had one not very long ago where the appraiser actually came from Lake Jackson, which, if you know where that is, and Patrick does because that's where he's from, it's south of Houston, and the appraiser came to Austin to do an appraisal for a bank here in Austin that made a loan. And the house was in Jester Estates, and the appraiser used comparables from Jester Farms, which is in Pflugerville, and it took me about 2 weeks to go through the protest process and get that thing fixed. So, yeah, it's changed a lot. Also, go ahead and tell us what some of the other ones are.
Well,
just average condition.
Average condition is basically, it would just mean pretty much livable. I mean, if you have broken windows or bare floors, you need really a permanent heat source, things where you probably wouldn't want to move into the house. And so a gutted house, we're seeing more foreclosure sales, and so that can create some issues if it's been, vandalized. So we're really looking at average condition. Clear title, the lender reviews the title commitment, and title insurance is obtained to make sure that there's clear title to the property. And then
that means no liens against the property that no one knew about.
And then it has to be insurable as far as getting homeowners insurance. And so, generally speaking, you'd have to have a roof with an economic life of at least 3 to 5 years, and just be insurable with the normal A-rated insurance companies.
So when you locate a home, one of the things that you'll do is have a property inspection. And during that option period, you can also have a commitment for insurance issued, or a binder. Have your insurance company come out and give you a quote for the property. And I guess that pretty much takes care of the average condition. The lender wants to make sure that it's in good condition because the property is collateral for the loan.
And when we order an appraisal, that appraiser that goes out to inspect the property, he's not going out there to look to see if the refrigerator's working, but he is the eyes for the lender to see what kind of condition it is and if it's in a average at least condition.
Good. Yeah.
And this is one of the recent changes too. Basically, and it gets to be more difficult when you go, especially in January or February, because generally real estate's a little seasonal where there's not as many sales from Thanksgiving to Christmas. And so there's not comparable sales within the last 90 days. The lender wants to try to find the most recent sales to be the real market for what houses are selling for. And so a lot of times in certain subdivisions, there hasn't been any sales, period, or if there is sales, they're not what's called comparable, meaning they're not similar in size, amenities, which means square footage, number of bedrooms, and number of baths. And so when it's difficult to find those comparable sales, then a red flag goes up with the underwriter because the appraiser has to make adjustments that are above what would be normal 10%. So for example, if your house was 2,000 square feet and the only sale in the neighborhood was 3,000 square feet, well, then that's not very comparable because it shows there's really not a market right now for your 2,000 square foot. So it's really hard to use that as a comparable. And so if there's nothing in your immediate subdivision, then the appraiser has to go outside the subdivision, and that's another red flag because they have to go outside, and it becomes more dissimilar when they go to different subdivisions. And so when you get later in the spring and the summer and there's more active sales, it's a little easier to find comparable sales. But It just depends on, and so you really want to watch your neighborhood to see what's really moving, and that's where Patrick and Laura are really a great resource, because they know the market and they know the trends, and they've been doing it for a long time.
If you haven't subscribed to our market report, that is a very valuable report. Patrick does it every single month, and does it by zip code and price band and area, and it's great information. One of the things that really surprised me, Todd, was the new formula really for figuring the adjustment for square footage.
Yeah, most people, when they're looking at houses, they say, hey, I'm looking at this house and it sold for $100 a square foot, and my house is bigger and better. And of course, everyone's own house is always bigger and better. But let's say, for example, your house was 2,000 square feet, and the neighbor's house sold for 1,800. Was 1,800 square feet. Well, if it was $100 a square foot, you would just think, well, God, his was 1,800. Yours is 1,800 square feet, so it should sell for 180,000, and his is 2,000 square feet times 100 should sell for 200,000 or appraised for 200,000, and it's not that simple. Basically, the appraiser doesn't adjust just for that $100 per square foot.
Right.
They basically take 30 to 35% of the square footage adjustment, and that's how they adjust. So your 200 square foot bigger house, or in your case 200 smaller, would really only adjust by about $6,000 to $8,000 difference on an appraisal, not 200 square feet times $100 a square foot when you thought it was a $20,000 difference. Basically, because the lot size is already there, the foundation, etc. So that just difference in square footage would not amount to $100 a square foot adjustment, but more like 30 to 35% of that $100 per square foot.
I actually don't agree with that strategy, but then we don't get to make the rules because we're not lending the money. All right, choosing a lender. Again, we talked about this a little bit at the beginning, but I just can't stress enough the importance of choosing someone that is honest and will visit with you, look at your criteria, look at your goals, the goals of your family, and make a recommendation on the right loan program for you rather than how much the lender's going to put in their pocket. And that happens every single day. It's also important to have local underwriting and local processing. There are some lenders that have those. Oh my gosh, the one that I was telling you about where the appraiser came from Lake Jackson. When I tried to do the protest for that particular appraisal, I dealt with people in 5 different cities trying to get that cleared up. So it's so valuable to have everybody local. It just really is. And, lenders will occasionally promise you that they can get something done in a period of time and at a rate, and then they can't deliver. So, choose carefully. And like Todd said, he's always glad for you to talk to multiple people, and that just gives you more information to make an informed decision. So we really do agree with that. I know some of you probably have questions, and so I'm going to go with Patrick and let him direct that.
Okay, one thing I wanted to say to a lender too is a good lender won't ask you what other lenders are quoting you as a rate. They will say, don't tell me. I will, tell me your let's go through your file and we'll qualify you, and I'll give you my best and honest answer. When a lender's asking you what other people are quoting you, he's not looking out for your best interest. But okay, so a few questions we got here. I wanted to do an investment property. How many loans can I have?
Well, to do Fannie Mae and Freddie Mac type financing, which is generally going to be your best rate, fixed rate loans, Fannie Mae and Freddie Mac will allow you to have 10 financed properties. Now that's Fannie Mae and Freddie Mac's rule. So 10 finance properties. So if you own a property free and clear, that doesn't count towards the 10. It's 10 finance properties. But now what you have is what's called overlays in the business, where Fannie Mae and Freddie Mac may have that 10 rule, but specific lenders like Wells Fargo or Chase or Bank of America will put an overlay on what Fannie Mae and Freddie Mac do. And most of those lenders have a 4 finance property limit. And so you'll probably be able to find a lender. USAA, for example, does over 4 finance properties. They'll go up to 10. There's a Flagstar Bank is another lender that will do over 4 finance properties. But generally, when you get over those mainstream, you're going to talk about a little bit higher rate. So, but it can be done up to 10.
That's great information, Todd. We just talked about appraisals. How do appraisers factor in foreclosed homes in the neighborhood that have sold?
Well, what you look at it from an appraisal standpoint is that foreclosure an outlier, or is it kind of the norm? If there's a high density of foreclosures in a certain subdivision, then they've got to document it. And if most of the comparables are foreclosures, then that's where the market is. If there's one isolated foreclosure and the rest of the market supports a sales price of $150,000 and that foreclosure is the outlier, then they basically can disregard it. They'll make a note of it in the appraisal, but that's why they'll look for additional comparables that have sold that aren't foreclosures.
So they might have, say, 4 comparables that they're using in the appraisal, but if they're a foreclosure in the area, they might go to 6 comparables?
They may go to 6. They just want to make sure that they address that there is a foreclosure. What the underwriters want to make sure is that the appraiser didn't leave it out on purpose, so it wasn't factored into the opinion of value from the appraiser.
Okay, great. I got another question here about condos. Are there different loan qualifications for buying a condo versus a home?
Condos have become more difficult to finance if they're not FHA approved. If you find a condo that's FHA approved, it's much more marketable, and I would definitely recommend buying an FHA approved condo. You can go to there's a list on hud.gov that gives the approved condo list. If it's not FHA approved, then the lender does an analysis not only of you as the borrower, but has to check out the condo complex. And what they're looking for is they don't want a high concentration of rental units. So, for example, a lot of the downtown condos, when they weren't able to sell them, they started leasing them out. And so generally those are going to be ineligible for low down payment financing with good terms because they don't meet those Fannie Mae, Freddie Mac requirements because too many of them are rented out.
Wow.
Now there are alternative sources. Generally, if you have a large enough down payment, 20% or more, and you want to go with a higher interest rate, you can find a local bank or credit union that will do those types of loans, but just be careful because if it's more difficult for you as a buyer, then it's going to be more difficult for you as a seller when you go to sell that condo.
Right, because the property qualifications become more paramount almost than the buyer qualifications.
Correct. You could make $1 million a year and have $3 million in the bank, but if the condo doesn't meet the requirements, it doesn't make any difference.
Well, Todd made a good point there, and we always when we consult with our clients to think with the end in mind, and the end is typically to have to resell the property at some point. And so when you're going to buy something, you want to make sure that when you go to sell it 5-10 years later, that it will sell. So great point, Todd. Thank you. Another question having to do, let's see here. Another question about loan qualifications to buy foreclosed properties. Are there anything specific that a lender might do or might not do that has to do with a foreclosed property?
No, basically what's happened is there was what they call a flipping rule, which means if it was held for less than 3 months, then that was ineligible for financing. But FHA is exempted bank-owned properties from the flipping rule, and so there really is no difference on a bank-owned property for financing. Now, if you're a investor and you're buying the property and trying to flip it and resell it within 3 months, it's going to be problematic for you to sell it. But if you're a bank that's the seller, then you get an exemption, and it's not a problem.
Well, just for like your normal home buyer, like a first-time home buyer, are there any incentives to buy a foreclosed property over the normal resale down the street?
The incentive, if you buy a Fannie Mae foreclosure, and you can go to homepath.org or homepath.com, it's Fannie Mae's list of foreclosed properties. If you buy one of their foreclosed properties, the down payment requirements are lower than normal, and so you can get a loan instead of 5% down, you could get a loan with 3% down, but the rates are a little bit higher. But there is a list of on HomePath. I think it's homepath.com.
Yeah, I think that's right.
We're gonna put all those links on the replay. So when we mention websites today, if you didn't have a chance to jot those down, we'll make those available for you. I just really want to thank Todd for coming out. I mean, he is so busy right now, and we just appreciate his time. I know you probably learned a lot and got a lot out of it. Patrick and I were both making notes too. So, I mean, things change, and we try to keep up as best we can. But the real source of knowledge for us are people like Todd, and we just appreciate you coming out, Todd. Thanks so much.
Yeah, I have to say the same thing. I learned a lot actually today too. Like Laura said, I was jotting down notes quick as possible. Wanted to point out right here on this page, the West Austin Marketplace. Highly recommend you subscribe to our blog. You can get updates on all this kind of information. We're constantly trying to stay ahead of the market and learn what's going to happen and things are changing so quickly too. Todd's contact information, of course. Feel free to reach out to Todd as a resource. I highly recommend you talk to him if you're looking to get a loan on a property
Or refinance.
or refi, definitely, because the rates are still low. They're going up, but they're still low now. And also, Homes at West Austin. You can email us anytime to get information. Thank you so much, Todd. Thank you so much, Laura. And y'all have a great night. Thank you for joining us.